Just checking to see if everything's good today. Very nervous right now. Okay. I can see the YouTube. All right. Wow. Welcome, everybody. Very nervous today because if you tried to tune in last week, you realized that I sent the wrong link out and blasted it out to my email, Twitter, Facebook, pretty much everywhere. And the link was wrong. So I think I let a lot of people down last week. I do apologize for that. I very much appreciate people tuning into the live streams. I know your time is valuable, and I really appreciate you spending, an hour or so to hang out and talk shop here. Didn't mean to disrespect everybody's time like that. I will make sure that it doesn't happen again. Essentially, I was trying to live stream to multiple places and didn't really know how to use the software, and it actually ended up going to the wrong place. So it appears, I don't want to get too excited yet, but it appears like we are back to where the link that I sent out, I think it is actually the correct place. So good to go, hopefully. And what we're going to talk about today, there's going to be 2 segments. I'll try to do 2 segments, and then we always do the open Q&A. I'd like to leave a little bit extra time always for those Q&As because I know it's very difficult to get your questions answered online. You follow a bunch of people, and very few people are available and have the time to do that. So Q&A gets priority all the time in my live streams. But I'll try to do a couple of segments, and today we're just going to answer 2 email questions that kind of came up repeatedly in the last few weeks and feel like maybe other people will want to listen in to the answers. So we will get right into those segments in a second. Let's just play a quick little intro and then we'll get started. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so as far as I can tell, we're on the right stream today. Not messing around with that Clips channel today. But if you do want to subscribe to that channel, I left a link in the top of the live chat. You can go on over there. Basically, I'm just going to be taking all of the more interesting questions from the Q&A and just uploading them as just clips every single day. We've done, this is number 26 for the public streams. We've done more than 26 privately. So there's a good 100, 200 hours of Q&As there where I think there's a lot of good questions. So I'm just going to be doing that every single day, and I don't think I'll ever run out. So you can go ahead and subscribe to the Clips channel. But let's get on with what we are going to talk about today. And the first segment, I will just read the question here for you. Essentially, we're talking about broken wing butterflies in this first segment. And a follow-up question, typically get this one a lot in various different forms. For our VXX Broken Wing Butterfly trades, the trade instructions say 1% net liquidation value of capital. But how does that translate into number of contracts? So let me just make sure I'm on the screen share here. Okay, so we are looking, of course, today the market is up. Good to see. What I'm going to do first is let's just talk about what a butterfly is really, really quickly. This is the one that we have open currently, going reasonably well. It's up about $646, but it's got a little bit of time left, so a little bit early to start deciding whether that's a winner or a loser. But let's build a different one. So the one we have now is November 26th. Just going to go 1 week out and build a standard butterfly, just to show you what that looks like. We will have to expand these wings out a little bit, so it looks a little bit more likely to be a trade that somebody would put on. And this is what your standard butterfly looks like. It is an equal, basically market neutral, delta neutral trade, as long as you're putting your strike somewhere in the middle there. And it's a very good trade. Like on its own, I use these sometimes, and I think it's a good risk-reward profile. Very similar to an iron condor, similar to a calendar, different Vega exposure, but they're all the category of delta neutral trading. But what you can do with butterflies, which is what I most often do, is you can do what's called a broken wing butterfly. Now, just as a side note, really quickly here, if anybody is interested in getting a more detailed explanation of this, if you go onto the YouTube channel, the main YouTube channel, and type in butterfly, there will be 2 videos. So you can do the first video, long butterflies, get a basic introduction to what it is, and then the follow-up, the broken wing butterfly, again, another 10-minute video explanation going into more detail of what they are. But essentially, this is your standard butterfly. Broken wing butterflies, I prefer them because it allows you to get a little bit of directional exposure by transferring the risk from one side of the trade to the other side. Now, you don't have to transfer all the risk. It's just to add a little bit of directional exposure. So this is the VXX. And with respect to the VXX, the way I typically trade these is I transfer the risk from the high side over to the low side. Because what do we know about volatility? The dangerous side, of course, is over here if the VXX spikes upward violently. Doesn't typically vol crush down to the point where in 1 or 2 days you can be in trouble, but that can certainly happen in the matter of minutes on the other side. So what I would do in this case is I would break the wing and it would look like this. So this is a broken wing butterfly where there is some of the risk from over here transferred to the bottom. So now the dangerous side is over here. The reason that I would be comfortable doing this, you can see if the VXX just naturally decays downward, and in 3 weeks or so it's all the way down below 18, this is now a losing trade. However, of course, with my portfolio, I have 80% of my capital currently net long the market and net short vol. So I don't really care if a small trade that I'm putting on actually loses money here, because by default it would mean that the rest of my portfolio made far more profit than this trade lost. So that's what I typically do. Zero risk if volatility spikes this way. So this is the standard broken wing butterfly. Now the question is, how do you actually scale these to a portfolio, right? That is, remember, that's the question here. Where is it? The question is, when I send out trade instructions, I always say 1% of net liquidation value is the size of the trade. But what exactly does that mean? Butterflies are easy to scale. If you just go back to the standard butterfly, it is a limited loss trade, 16 cents. You just times that by 100 and you know exactly how much it is per contract. But broken wing butterflies are a little bit more confusing. So what we're going to do is we're going to do it 2 ways. Again, just let me double check the live chat here. Just making sure there's nobody screaming that it's the wrong link again, because I've done that. Okay, good. So what I'm going to do here is I'm going to explain this in 2 ways. The first way is, as I said, using a good trading platform. The reason I say this is because I don't exactly know what your trading platform looks like on your end. Personally, for me, I do my long-term portfolios with Interactive Brokers. Now, with Interactive Brokers, it's a very ugly software. It's a very good platform, but it's a very ugly software. You can do it. You can look at the analytics and portfolio builder, and you can see, as you're adjusting the contracts, what the maximum loss is. And in Thinkorswim, which is what our live stream account is, right? Remember, I funded this account with a little bit of money so we could actually see some live trades going. With Thinkorswim, this would be qualified as a good platform. You can actually just go over here and you can see what the max loss is. So right now, for this trade, we can see the maximum loss, that turquoise number, $81. per one contract. So all I would have to do to scale this is just adjust the contracts and just look over here and see what I'm risking. Max loss, worst case scenario is always over here. So if I just scale 1%, this account currently has, let's just say 267,500 times 1% net liquidation value. That's what this trade is. I would like to risk 26.75 on this trade. And I will always round down. So I will just adjust this until it says 26.75 or just below, right? So I'm at 25.11, 25.92, probably one more, 26.73. I'll go down one just because of trade fees. And there you go. I'm risking $2,592 on this trade. Very, very easy. I would open 32 contracts and I would just execute this trade. Now that's the easy way to do it. So hopefully on your end, your software is either Thinkorswim, which makes it very easy, or one of the other platforms that is also fairly easy to work with. I've never actually used any of the other ones, Schwab, Fidelity, Tastyworks. I don't know what they look like, so I can't be certain that yours is that easy. So when I'm giving the email and it says 1% of net liquidation value, I'm essentially assuming that yours is like that. You're just going to literally take 1% of your total capital that you have dedicated to VTS, and you're just going to risk that much money. And again, cool thing about the butterfly is, let's just say worst case scenario, the VXX expires below 18 in a few weeks. As we know, the VXX decays roughly 1.1% a week. So down 3% would be normal. Under conditions of fairly strong contango, probably it decays maybe double that, so say 6%. It's right here now at 2042. So typically, I would say 2042, I'm looking at about, say, 2% a week, 3% a week. 3 weeks from now, let's just say times 0.92. It's going to decline 8%. Well, 1876. We're looking at a price right around there, which happens to be pretty much exactly on the break even. So if the VXX just does what it does and it goes down to the standard, what we would expect under strong contango conditions, remember, average would be about here. Strong contango brings it to here. This trade loses no money. The rest of my portfolio makes a lot of money because it's net long the market, net short vol with the VXX, and everybody's happy. Let's say it goes down a lot. Well, it goes down and it loses the full 2,600. Bad trade. But as I said, the rest of the portfolio would make far more than $2,600. It would probably make 5 or 6 times that at least. So I wouldn't really be too concerned if this broken wing butterfly loses money. But it could, so it goes down to there. But that's the point and the strength of the broken wing butterfly. And that's why scaling is so important. Because if you get this to be too big, let's say you risked 92 contracts, well, now all of a sudden, if it goes really badly, I could lose $7,300, which probably the portfolio would make up for that. But you can't be certain because volatility isn't directly correlated to the stock market. It's about 75% correlated. And of course, there's no causation there either. The VIX futures are free to do what they do, and the S&P 500 and the NASDAQ, they're free to do what they do. So you don't want to get this calibration wrong on your end by going too heavy. So that's why, for me personally, I always think 1% of net liquidation value works very well. And that's a very simple way to scale. You just look at your trading platform, adjust the contracts, and you're good to go. You've got a trade that is only 1% of your capital. The other way, this is going to scare off a few people who don't like looking at math, but trust me, it's far easier once we actually explain this. The second way is actually with a formula. So this is basically the formula for scaling broken wing butterflies. Now again, don't be freaked out by this. I'm going to explain how simple it is, and you can really, once you get the hang of it, you can actually just look at the premium and you'll be able to do most of that formula in your head. Even for the people who are maybe not so great at math or, back in school when you see formulas, you cringe. I wasn't one of those. I was cringy when I heard Shakespeare or poetry. I kind of like looking at math, but some people, I get it. So let me explain it in the simplest way possible. You are taking your net liquidation value and you are taking 1% of that. So the numerator here, the top part of this formula, is your trade allocation. This will be 1% of your capital. On the bottom, $100 plus the premium that you get for your trade times 100. Now, the 100 is just because one option contract is worth 100 shares of the underlying. That is true of all options. So that is just the option multiplier. Your premium is what you execute for, which is minus 20 cents in this case. And the $100 comes in because it's a broken wing butterfly. There's actually a $1 larger gap between these two strikes. So you will be working off of a set $100 multiplier. So probably sounded a little complicated. Trust me, it's much easier than that. Let's go through an example. So really, really quickly, for the trade I just built, I said 267.5, right? 267.5 times 1%. $100, the premium for this trade right now is 20. I'm going to lock this so it doesn't change, and we're just going to go minus 20, okay? So what does this equal? Well, here, I'm going to do this with this super slow calculator. Obviously, you'd want to use just your iPhone sitting next to you. It's much faster. But 267,500 times 0.01. Bear with me. I know this is hard to look at. Looking over somebody's shoulder as they're doing calculations is always extremely annoying. I get it. But then you just take that. Now you calculate the denominator, which is just the basically 80 there, right? But I'll go through it just so you can see it. The minus 20 cents, right, times 100. Remember, with order of operations, you do the inside the brackets first. So we've got 20 bucks there. And it's actually a negative 20, right? You've got the negative 20 plus $100. That's it. So you've got 80 bucks. Now, of course, I'll get to in a minute, but you can actually just see that if you just look at it in a second. But there we go with the 80. So 26.75 divided by 80. And the right scaling in this case is $33. 33 contracts. This is a correctly scaled trade. 33 contracts. If we go over here, max loss is 2,640. That is 1% of this account value. Now, again, please don't think that you have to do this every single time you scale your trades. It's really a lot easier than that. Once you do a couple of these, and this is true for all of option trading, which I have found. I've been teaching and educating options for a long time, and what I find is there is a very steep barrier to entry initially. People look at it, they think it's all math-based. They think, well, I don't know what Vega is. I don't know what, delta and gamma, and these are all very confusing things. One of my pet peeves with option educators out there is I believe in many cases they intentionally make it sound complicated, so it puts them up on a pedestal like I'm the educator, I'm the experienced one, I'm teaching down to everybody else. And then they speak with this really complicated options and volatility lingo. It is completely unnecessary. So when you see option trading, I understand initially, there's going to be that wave for some of you. It's just, I can't do this, right? But trust me, everybody from every background can do this. So let me try to simplify that a little bit. If you do one or two of these trades, what you will notice is because we break the wings always sort of the same way, with it's just a $1 gap between them, you already know that you just take 1% of your account value and you divide by that, what you might look at as a fairly complicated numerator-denominator formula. When in actual fact, you just take 20 cents minus the 100, and you're going to know it's 80 in your head, right? Everybody knows $100 minus 20 cents in your head. Let's say, for example, you did a different trade, 19, 20, 17. Well, in this case, the premium for this trade is plus 8 cents. So, simple example, what do we know about this trade? We take 100 and we add the premium we get. In this case, it's a positive premium, so I'm going to add 9 cents. Well, it should be $109 for the maximum loss, right? If you look over here, delete that one. There it is, $109 on the maximum loss. We can all do this in our head with practice. Just one or two trades in, you're going to just look at this and say, oh, 9 cents plus $100, that's $109. I'm just going to divide 1% of my account, divide by $109, and I'm good to go. If you really did want to go through that, you could go like this, and you could make sure that that's a positive number, and this would be 109, and then that would be whatever it equals, right? That's the number of contracts. but it's actually much, much simpler than people think it is. So that is how to scale the broken wing butterfly. Now, if you're interested, that original trade that I put on, that trade actually looks pretty decent to me. Sorry, 21. This trade is something that I would probably look into if I was to take a trade right now today. What I'm essentially looking for is just a checklist of 3 or 4 things. Number one, I don't want any risk to the high side. So good to go. We're above zero. We're collecting a little bit of a credit there. And that's really it as far as the scaling, because I already know that I have a portfolio that is very benefiting from a net long exposure to the market. The second thing is, if at all possible, you do want a negative premium here. You want a credit brought in, because that way every time volatility spikes, I'm going to make a little bit of money. Obviously, I want it to decay slower and to sort of stay in the heart of the area here. But if it just spikes up and you get one of those off weeks, then you're going to get paid a little bit for that. And remember, the exact scaling is supposed to be 33 contracts. So for me, obviously, I would like to make 2,000 or 3,000. But in this case, if I just scalp 660 and the trade, volatility spikes up and I'm out, I got a little bit of capital for it. But that's a nice looking trade to me. And trust me, with a little bit of practice, everybody can do this. I will do option trading in the future. We will be doing a course. I have we did the VTS options, which was a service that there was a large number of trades going out. There was not a course underlying, but I did explain everything. The way that I educate people with options, I will not bombard you with all of that volatility lingo and make it all complicated and hit you with a bunch of formulas. I could definitely do that. There is a way to make it sound like it's the most complicated stuff in the world. But what you will find is that while option trading itself and being profitable in a very, very ultra competitive market, which is the options market, especially within the volatility space, it's even more competitive. The best way to attack it is almost always with simplicity. So you want to make sure that you're highly educated so that you can compete and beat most of the people that are option trading. But you want to do it in the simplest possible way. You want to reduce your strategies to simplicity. You want to get your lingo to where most people can understand it. And that is the best way to approach it. So if you were ever wondering, you go on Twitter and you follow these volatility experts and it sounds like, wow, I've never even heard of half of these words. It's probably unnecessary. It's just designed to sound like it's just this unattainable level of experience and education, where really in a few short weeks, you could probably learn enough to get in there and start trading single contracts and start actually mixing it up in these fairly aggressively competitive markets. So I will not do that to you guys. I promise I will try to reduce everything to simplicity whenever possible. So that is how you scale broken wing butterflies. Now, as far as the emails go, I always just say 1% of net liquidation value, but I will try to find a way. Maybe I will include that formula in some simplified way. But like I said, next week, if you do the trade next week, you will see premium minus 100 or plus 100. There you go. There's your multiplier. It's actually pretty simple. So the second thing that we wanted to get into is a totally unrelated question, but something that I find interesting, and maybe you guys do as well. Segment 2 today, the question is it possible to show a backtest for the defensive rotation strategy using the S&P 500 instead of the NASDAQ? I feel like big tech stocks are overvalued, and I may want to just use the S&P 500 for a while. Okay, so this is good as well. So what they are essentially talking about here is one of our strategies within VTS, and I will try to speak today as if you're not a member of the community. I don't want my live streams to just be exclusive and applying only to people who are actually members. You don't have to be. I'm going to talk about diversification and the differences between all of these indexes. I will try to make it interesting for those of you who aren't in my community. But what they're essentially talking about is the fourth strategy here. Our core position, when everything is stable and volatility metrics are cooperating, we will be holding the NASDAQ, and in this case, leveraged 2 times the NASDAQ, the QLD. The person is saying that they feel like stocks are overvalued, tech stocks specifically, and maybe they want to substitute the S&P 500 instead. So what I'm going to do with this one is, first of all, explain that we actually do use 3 different tactical strategies. And this question, essentially, the reason I like it for a live stream is it's talking about diversification and the importance of diversification. So if we look at what the NASDAQ actually is, all right, so the baseline is the Qs, and then I use the QLD for our leveraged portfolio. But the holdings of the NASDAQ, this is what is in the Qs. And you can see it is extremely top-heavy on the biggest companies in the world, right? We've got Apple, Microsoft, and Amazon making up roughly 1/3 of the entire NASDAQ index, just 3 companies. So this is why sometimes people often say, well, if you're investing in the NASDAQ, you're essentially Apple, Microsoft, Amazon, plus a bunch of extra stuff. And this is why the person's asking the question, well, what if you thought that these companies were a little bit overvalued? You wouldn't really want to be overweight them, would you? So maybe you want to look for some substitutions. So this is the NASDAQ, 45.7% technology heavy. So let's look at the S&P 500, which is the proposed replacement in this case. So we've got the SPY, and what we will see, I'm going to go through several of these, but what we will see with the SPY is, first of all, while it is still the 500 largest companies in the world, and of course Amazon, Apple, and Microsoft, as well as your Facebooks and even your Tesla down there, they're all going to be in here, but they are at a lower allocation because there's more companies in here and the allocation is less. Still 27% for the top 10 companies, whereas the NASDAQ was 53% of the NASDAQ is only 10 companies, and a lot of them, of course, big tech. The S&P 500 is 24% big tech, whereas remember the NASDAQ was 47, I believe, 45, right? So getting better, but again, if you substitute for the SPY, which I will show in a few minutes, you are still a little bit tech heavy. So maybe this is a good balance in between. You want to do the SPY, you're a little bit less exposed. But there are other indexes as well. So I'm going to look at some of these. One of my favorites, the MDY. The MDY is the S&P 400 mid-cap index. So these are not the largest companies in the world anymore. This is a very diverse portfolio of stocks, but it is not the largest companies anymore. These are the top holdings for the MDY. You can see that, first of all, none of them have massive weightings. This is not an equal weighted index, but it roughly scales to something like that, right? It should be about 0.25 each. But it's actually very, very diversified here. 6% is the top 10. And here we're looking at the largest being industrials, second largest being consumer cyclical, and then financials. So this is actually a very different index from the Qs and the SPY. So this would be put on people's radar. You could potentially, if you wanted to scale away from the large tech companies and into more of just the equity market, MDY. Well, what about the good old Dow, right? We know that the Dow Jones Industrial Average, you could also go here. Now, the Dow is 30 companies, 31, I believe, right now. But here's the Dow. Again, we've got different names here. Microsoft is in there, but we don't have Apple, Amazon here. These are different companies, and the scaling is a little bit different. In the case of the Dow, largest being financial services. And then healthcare is a big one, industrials, technology, fairly evenly weighted among some of the other industries. And the last one I'm going to show you before we get into the actual results of this test is the IWM, right? The iShares Russell 2000. The difference being here, of course, benefit, nothing is overweighted. There's that AMC, which has been an absurd company. So I guess it's 0.65% of a company that is, in my opinion, pretty garbage. No offense to everybody who's on the AMC and GameStop train. I don't mean any offense. It's just not in my wheelhouse of things that I look at as far as investments. But hey, whatever. It did what it did, and a lot of people made money. But what we can see with the Russell is actually healthcare is the largest holding here. And then you've got industrials, technology, financial services. So all of these are different. And that is one of the overarching points that I want to make today, is that not all broad-based equity indexes are equal, right? There is a lot of differentiation between what industries, what companies, and what scaling goes into those. So it's not so easy if you're building strategies to just say, well, I want stocks. Let's just pick one of the five. They're all the same. They're not all the same. They will behave roughly the same because correlations are high, but they're not all the same. So you want to make good decisions as far as pairing based on what you're trying to do. Obviously, the famous comparison would be the ARK Innovation ETF, where it is basically the NASDAQ plus an overweight Tesla, right? So obviously, a person designing something like Kathy Wood designed that ETF, they would much more favor the NASDAQ rather than the IWM or the Dow or the MDY. That wouldn't make sense for her. Her philosophy is, let's just heavily overweight on tech because that's obviously what they're trying to do. That's where they think the world is going, and that's fine. I'm not here to say otherwise. I don't personally like the ARK Innovation ETF, but I did a whole video on that. There's a whole live stream, a whole hour on the ARK, so you can look at that. But not all equity indexes are created equal. So now let me get into the actual back test of what the question was asking. So let me get out of all these windows. What have I got open here? Sorry, a lot of clicking. So the question, what could we do? The baseline, these are the NASDAQ only positions within the defensive rotation strategy. So just to make that crystal clear for everybody, what you're actually looking at isn't the actual strategy. This is the actual strategy, including all of the holdings. But you can see that the NASDAQ is right here, and the unleveraged version, the NASDAQ is here. And then it also holds bonds when we need to, utilities when we need to, and cash when things are really collapsing. So the entire strategy is this one. What I'm actually showing with these charts is just the QQQ whenever we're holding just the Qs. So that's what this chart looks like. Just the Qs. And it is the top performer within the defensive rotation because the Qs, the NASDAQ, is the top performing index among these five. But we can see that while there is a correlation, there is a little bit of a difference with how these results will be achieved, right? Obviously, the Dow here, you can see it's dragging the lowest, but the Dow actually has the lowest drawdown. So it would depend what kind of investor you are. Are you the type of person that just wants to see the chart go as high as possible? Or are you the type of investor that looks at that and says, wow, the drawdown's actually quite low with this. Maybe a slightly leveraged Dow would be better than the IWM, right? Comparison for comparison, the IWM in blue is actually up here. It's the second best performer. The Dow's the fifth. But it got there with nearly double the drawdown. So what would maybe a conservative investor might look at that and say, well, the Dow's more consistent. At least when I'm holding it, it's more consistent. And so maybe you could do a little something with that. The point is that they're all different. They will all get to the final place looking the same. But because the holdings are different and the allocation sizes are different, the industries they focus on are different, you really do need to match up to what you're doing. And another example I can show you, I went through the numbers again. This wasn't part of the question, but interesting to me, because my longest running strategy is actually the tactical balanced. So same thing, tactical balanced is this strategy here, and what I'm only showing the MDY portion of the strategy, not showing whenever we're holding bonds, whenever we're holding gold. Not showing that right now. We are just showing MDY only highlighted in blue. Obviously, the Qs have outperformed it, but interestingly, we can see when the deviation happened. So I officially launched this strategy within VTS on January 1st, 2012, which is actually right here. That's when I launched officially with real paying customers the tactical balance strategy. Now, at the time, if you can imagine me going back, I traded it for a few years before it was launched, and you can see why I used the MDY with this strategy, because at the time it was the best performer. And while I'm not always a victim of optimizing for performance, in the case of these 5 choices, and I include probably 20 different choices, the MDY was the clear winner for this specific strategy. But obviously tech, you can see right about 2015, it was just accelerating on us, right? You've got the Apple, Amazon, Tesla, Google, Microsoft, all just exploding. And so it's not surprising that had you done heavy tech for the last 5 years, you would have performed a little bit better. But again, same deal here. We've got different drawdowns for different strategies. So it depends on what type of investor you are. Do you value the SPY at less than 12% drawdown? Well, it's worth something. 2 or 3% might not seem like much, but when you're in the moment, and specifically when you're using leverage, you can double those, it does actually start to matter a little bit. So long story short, it's the same thing as the other test where you can see clear differences in how these perform. And because this one can actually go back a lot further, this is all a back test here because these metrics were available to me long before, whereas the other test, wish I could, but I actually can't drag it back further than this because the volatility metrics I'm using within this strategy didn't exist before the 2012. So I can't drag it back and show a back test any further for this strategy. But for the tactical balanced, I actually can. And we can see that there was a shift. There was a clear shift where, the Dow here, the SPY, one of the worst performers when I actually launched the strategy was the SPY. And now all of a sudden it's pretty much caught up and it's tied with the Dow and the MDY and the SPY. Nothing yet is with the tech, but I do want to remind people, when you're optimizing your strategies, don't always optimize for performance, right? Have an eye to what you're trying to achieve, drawdowns you're trying to minimize, what industries you're trying to focus on. Don't just look at the numbers, oh, the Qs went so high, because we have to remember, and just as an example, in the dot-com bust, not saying that that's going to happen again, but remember the S&P dropped roughly 50%, but the NASDAQ was down 78% during the dot-com bust. So not saying that it's going to happen, but you can imagine that if there is a major financial crisis, some of the frothiest, most bubbly stocks out there might actually be the ones that crash the most. And if you go back to the dot-com bust, even some very good companies crashed a lot more than 78%. Some of them, the Intels of the world and the Oracles and whatever, 90% or more. So don't always optimize and think, okay, well, the NASDAQ's the best, so I'm just going to fire the NASDAQ into everything that I do. That's probably not advisable. And that brings me to the second point, or that is the first point, that we actually have 3 strategies that use all 3. So here are the 4 tactical strategies that we have. This one is using volatility ETPs, so we'll ignore that. But tactical balanced uses the MDY. VB threshold uses the SPY and the SSO for double leverage. And the defensive rotation uses the Qs and the QLD for double leverage. So we actually do use all 3 of those top performing indexes. I think it is worth diversifying into all 3 of them. So we do use the Qs, the MDY, and the SPY. To answer the question, before we get on to a few other things, to answer the original question, I would personally say there's no need to allocate away from the NASDAQ into the SPY because we already do that within 2 of our tactical strategies. We're already using the SPY within the VB threshold. There's no need to double up on the SPY. What I would like to see instead, maybe you would go to something totally different. Maybe you'd go to the Dow because we're not using that right now. I wouldn't recommend the IWM, the Russell 2000, but the Dow is certainly on the table. So instead of going to the SPY, maybe you would consider that. And for that specific investor, at that point, they would have the MDY, the SPY, and the Dow covered, and they would be excluding the Qs. Remember, as we showed with the holdings, it's not like the SPY doesn't hold tech. It does. I mean, this is a fairly large allocation. You've got, 15% of the S&P 500 is only 3 companies. So you are already, not heavy into them, but there is some allocation there. The second thing, as far as diversification goes, this goes beyond the question, but important to say, is that all 3 of these strategies that I pointed out, they all use different volatility metrics to get their signals. So it's not just 3 strategies getting signals from the exact same place. They are all using different volatility metrics. So depending on where the volatility barometer is, where all of our cash VIX oscillators and the VIX futures, roll yield, all of these things, the cash VIX term structure, the VIX, the 9-day, the 3-month, 6-month, depending on how they are all built, they're actually all different as well, which adds an additional layer of risk management. We don't want all three strategies getting signals from the same place. So within my portfolio, these three strategies use different ETFs, and they are different strategies. And the third thing is they actually use different safety positions as well. So what I will mean by that is when volatility is elevated, tactical balanced moves into short-term bonds or gold. When volatility is elevated, the VB threshold moves into real estate, and when it gets really bad, long volatility. So this is probably our strongest tail risk strategy is the VB threshold. So it can hold the SPY, the S&P 500, but this one is real estate and long vol. And then defensive rotation moves into utilities or cash. So when volatility is really elevated, it's actually in three different asset classes on the high end. On the mid side, when everything's stable and normal, there's no reason not to hold stocks, right? I don't really want to hold bonds right now. The market is smooth sailing. Yes, you can get hit with a single day out of nowhere, but most of the time, now is the time to be net long the market, net short vol. But safety positions are when things will deviate. What do I want to be holding when the market is crashing? I would rather be holding bonds, gold, real estate, long vol, utilities, and cash when the markets are crashing. On the other side, tactical balance just holds stocks indefinitely. If volatility gets super low, we just hold the MDY. That's what that strategy does. VB threshold will actually start holding gold. No need to hold stocks heavy when it might be at the top or, running on fumes. No need to do that. So when volatility goes very low, we will hold gold. And then bonds as well, same concept. When it goes very, very high or very low volatility, the market is maybe extended to a certain point. At that point, I want my portfolio to not be 100% net long the market. I would rather be in a diversified, as it happens, stocks, bonds, and gold portfolio. Basically a standard stock, bond, gold portfolio. And then again, on the high side, stocks, bonds, gold, real estate, utilities, cash, and long vol. Different allocations when things are not normal. But when things are normal like they are now, hey, why not just ride the trend? Why not just hold the things that perform the best in the moment? And that, of course, is stocks and short vol. So we've been holding that for over a month now. Another thing I can show really quickly, while the allocations are not exactly the same, right? You can see that the MVV, QLD, and the SSO, these first three, you can see the profit since we opened them. These are on roughly $50,000 allocations, each of them. But you can see it's different as well within the three strategies. That just shows that while everything is moving upwards, they don't actually move just in lockstep with each other. There are differences between these indexes. And during different market periods, if you go back long enough, you can see clearly the MDY was the top performer in the mid to late 2000s or 2000s, 2010s. Right around 2014, the SPY started catching up. Right around 2016, the Qs started accelerating. Who knows what the future holds? I don't. I don't ever pretend I have a crystal ball. So I just make sure that I'm extremely diversified. I hold strategies with all three of the major indexes, different volatility metrics producing those signals. So sometimes I'll be long stocks in one of them, but the other one is still hanging out in real estate or bonds. That happens all the time as well. Different signals for different strategies. And then lastly, of course, totally different safety positions. I don't want to have my portfolio allocated in the same directional exposure when it's so uncertain. Right now, things are not uncertain. I don't know why somebody would be holding heavy gold, bonds, or all the other assets. It's pretty obvious what we should all be holding right now. But the real strength of my portfolio is when things get ambiguous, that's when the diversification hits. And we're just going to cover a broad spectrum of different metrics and different assets. So that answers that question. Hopefully, that's your answer. I wouldn't substitute the SPY for the NASDAQ because we already use the SPY, so consider the Dow. And then for the first one, remember, just look at that premium for the broken wing butterflies. And trust me, it will not take you very long before that somewhat complicated math formula for some of you is just going to look like, oh, it's just nothing. You just take 1% of the account and you just look at the premium. So hopefully you are good to go on those as well. Now, I went a little long, as I always do. I tend to babble, but hopefully there was something of value in there for some of you. And now let's get to the world famous, the open Q&A. All right, let's get to the open Q&A. Let's see what everybody's been asking. So just as a quick reminder, of course, at the very top of the chat, I did include the link for the new clips channel. Go ahead and head over there, subscribe to the channel. You're going to get a clip every single day coming from these live streams, coming from, just maybe 3 minutes of a really important segment of a video. Clips channels are really cool to just get a lot of useful information, and it's not really, I don't have to spend a lot of time editing and presenting it correctly and making sure that it's super entertaining. Not that I am. I'm a very dry, boring person, but clips are pretty cool. You just open it. It's going to be a 3-minute clip right into the subject. So go ahead and subscribe to that. Okay. First question. Thank you for the videos. Do you share the historical values of Volatility Barometer? I want to test how replacing the equity exposure of the default ETF with custom stock model would have done. I think I just went through that sort of roughly for you, and I'm always willing to do this for people. If you email me and you say, hey, I wonder what it would look like if instead of a 20% allocation, you did 30, and instead of this ETF, you did that one, go for it. If it's complicated and I'm a very busy person, I might push it off a few weeks. I might make it into a live stream, but I'll probably get to it. As far as your first question about do I release the historical values, I used to. Unfortunately, no. And the reason is not a good one. It's one of those situations where a few bad people have ruined it for all of the rest of you, where I actually have a few copycat services out there that are essentially just regurgitating my signals, my strategies, in many cases, right down to the blog articles that I write. Clearly, they are subscribers, and they are just pushing my email to a community of their own. They have websites of their own. They have YouTubes of their own. And it's just a situation where I cannot provide all the historical values for what I'm doing now, because there are a few people taking that and redistributing it, basically, and trying to make money off it. And so the only real defense, I can't stop people from subscribing to my work. Like, I've got hundreds of asset managers that subscribe to VTS. I can't stop them from using my signals with their clientele. I hope they understand that that would be not only highly unethical, but also highly illegal. You would have to inform people where that's coming from, and they should probably contact me. I do have a consulting firm called Prosperitas Asset Management where we can work out a deal together where you can actually use my signals. I can't stop people from just subscribing for $80 a month and then doing whatever they want with it. But what I can do is make it a little bit more difficult for them to answer specific questions on the history of their trading, because there is no history for them. They have no idea what happened in 2014 because they weren't there. They didn't trade it. It's not their strategy. So if I don't provide those historical values, I know it's a very small thing, but perhaps their subscriber base that is asking questions, because I answer emails for 5 hours a day, I would assume they're getting bombarded with questions as well. If they can't intelligently answer them, maybe that would stop them from doing what they're doing, because I can't do anything about it. If somebody actually wanted to do that, I mean, I don't think they'd be very proud of themselves, and it's certainly not something that, as a man, they'd be like, yeah, I'm really doing well in life. I'm basically paying somebody else and lying. I don't think it'll make them happy, but they can do that. So, small thing, I do apologize. There are a few bad people out there that are abusing the generosity of me sharing so much, and so some of the rest of you will have to make do with getting private answers to private emails or live stream questions. It is what it is. I wish that I could just create it on the website and just have a downloadable link for everybody, but I think that until I stop seeing copycat services, I just unfortunately cannot do that. But like I said, if you have a specific question, I'm generous with my time and I will definitely get you the answer you're looking for. So do you ever look at 231 files? Sorry, flies. I usually compare it with broken wing butterflies to see which setup is better for my aims. 231 flies. What would you be thinking there? Are you talking about contract size? You know, not only breaking the broken wing butterfly, but comparing that to a butterfly with uneven contract sizing, like the longs and the shorts are not 212, they are 231. Not exactly sure where you're going with that. So I don't follow any work of anybody else. So sometimes these terms, you might think it's pretty common. I don't know what that means. Apologies. But as far as your general point, do I ever compare two things and choose the best one? Yes, all the time. And specifically within the broken wing butterflies for VXX, we can also do a very similar trade, of course, as you know, with just a straight up short call. So for the same expiration, I could, if I wanted, just sell this VXX single call, and it looks like this. Now, again, it checks the same boxes. We've got volatility spiking to the moon will not affect us. We will still make our full profit. And only if the VXX goes from here past here do we start losing money. But again, if that happens, sure, this specific trade will start losing money. But if the VXX in 3 weeks is below 18, believe me, the rest of my portfolio will be very profitable if that were to happen. So I would invite that. I would say that's fine. The individual strategy might show poor performance because we had a big losing trade there, but the rest of the portfolio keeps marching forward. So this short put, of course, is actually very similar to this. Even though the structure looks different, they are structurally quite similar, directionally quite similar. So yes, if that's what you mean by a 2-3-1, then yeah, absolutely good policy. You want to have a toolbox of multiple different option strategies. You don't want to just have one or two and just start jamming them into every situation that you see. Oh, I understand iron condors. I saw a video and they sound cool. So every market situation, I'm just going to sell iron condors. It doesn't really work that way. The option structure is never an edge. How you use them, when you use them, the entries and exits, the volatility metrics that you understand but the market doesn't. These are edges. Portfolio sizing, how to build everything so the correlations are correct, how to calibrate all of your hedges if you have them. Those are edges. So yes, you want a toolbox with several different options at your disposal, and then you look at the situation and you say, well, what's the best trade for this moment? So I went on that whole long spiel. If that's not what a 2-3-1 is, I'm going to look pretty stupid. But again, hopefully I said something that was meaningful there. Okay. In your blog, Tactical Volatility Strategy Through the 2020 Pandemic, your volatility strategy is 1/2 VXX or VIXY. Does that mean that 100% of the money would have been put in the volatility strategies in 2020 instead of 1/2? This would have probably doubled the return. So the article you were talking about is on the website. A lot of people are not aware, but I probably write a lot more than I do videos. If you're interested in just writing, I've been writing for years. So over a decade, I've been doing articles. And these are only the ones that I've transferred over to the new website since I left, what was it called? WordPress, and I went over to Wix. I haven't even transferred 500 of those articles over yet. So, but the one you're talking about is this one. It's actually the most recent one. And the answer to your question is what I showed here in this video is exactly the way the strategy is designed right now. So it is not a full allocation. This is what it would have been, the half size allocation, roughly 50 delta options. And for the aggressive vol strategy, again, this is only 1/2 of the VIXY. If I were to show the full VIXY, which I don't typically like to do, when I'm long vol, I do like to do it through the midterm futures, the M4 to M7, XIVM, or VIXM, or the VXZ. But yeah, it would double. To get the short answer to your question, yes, those charts that you're seeing would actually end up doubling up. But for me personally, I think taking a full 1x long vol exposure trade is not advisable. Long vol is an extremely difficult trade, notoriously difficult to hang on to your profit after the spike has stopped. It's actually not that difficult to make money long vol. It's very, very difficult to keep that money. So to give you an example, where is it? Long volatility is a frustrating trade. Let me show you why. This article number 584, there you go. There's a chart. This is just a standard back test. This is not anything that I would ever do. My strategies are much more in line to keep the profit that we make, so we don't get these givebacks. But this is what long volatility looks like on a long-term time horizon. It's not actually that difficult to go long vol when the market's crashing. Everybody can see it. Well, it feels awful. The VIX is over 30. Let's go long vol. That typically works for a little while. But then what ends up happening is the market bounces, and typically it bounces violently, and you get a massive vol crush, and you're holding 1x long vol when that happens, and you end up giving back most, or in some cases, all of the profit that you made previously. So you have to remember that long volatility, just like short volatility, there is half of it that is extremely easy to do. Making money being short vol most of the time is one of the easiest things in the world to do. I mean, everybody has seen the standard charts, right? Making money on a chart that looks like this is not that difficult to do, right? All you really have to do is avoid the drawdowns and boom, you're going to make some money. But short vol, it's very hard to trade short vol because these come out of nowhere and the spikes end up costing you. Long volatility is similar for an entirely different reason. It's very easy to make money with long vol, but it's very hard to keep that money. So to get back to your question, yes, that is using half sizes because for me personally, sorry, I keep flipping back from these screen shares. Apologies for that. You're probably getting dizzy at this point. But I just want to show the trade dials as well. You can see that aggressive vol says 1/2 VXY. That's for a reason. The VB threshold is VIXM, which is the M4 to M7 VIX futures. It moves about half the speed of long vol. And then we've got the tactical volatility that uses options. We're using VXX puts to short vol, and then we're using again 1/2 VXX. That is consistent with the article that I showed you. So that is a very long answer, but I think that it's useful for people to understand and just reinforce that over and over and over in your head is that making money shorting vol is one of the easiest trades in the world until it's not. And then boom, catastrophe, and you've given everything you made back. Long vol is actually not that difficult to make money either. You just wait for the market to decay a certain amount. You wait for the VIX futures to go into backwardation at a significant level, maybe -5 to -10, and then you jump in on the long vol train. And typically, there is a little bit of follow through when the market has melted down that much. You don't want to go long vol when it's just a hint of trouble, but when you're going long vol, when things have significantly deteriorated, not that difficult to make money short term. Very, very difficult to hang on to it. So that's why on the kickback, on what I call the dreaded give back, I would rather be holding a 1/2 position. And so we don't get, as it turned out, the aggressive vol strategy could have made 280% in 2020. But what I was showing there was a 1/2 allocation size, which is what I would recommend, or even lower than that. If you're not a, expert volatility trader with a lot of experience, no harm in going quarter size or eighth size. You're still going to get that convex pop when the volatility spikes. You're just not going to give it all back afterwards because you didn't really have metrics to, capitalize on it. How do you know if the spike's going to last 3 days or 3 weeks? That's difficult to do. So I always use slower moving long vol. Okay, the challenge for me with Broken Wing Butterfly is that with so many contracts, the order doesn't fill easily. I have to break it up into 5 contracts and keep tying them until all go through. So I cannot comment on how large your account is, but I can tell you that my account, and remember, I mirror everything in my long-term portfolio as well, which is a lot more contracts. I've not had any trouble. So these are live trades that are open in the market. This one was 30, right? So this is I wouldn't say it's a large position. It's a 1% allocation on a $268,000 account. If you had an account 10 times this size, you'd be looking at 300 contracts of this. I don't think it would be difficult to push 300 through, within 1 second. These are computers that match up contracts. I've also got another trade on UVXY is not even nearly as liquid, and this is a live trade on. I've got 26 contracts of each of these that is on, and I didn't have any trouble filling this, and I didn't in my Interactive Brokers account either. But like I said, I cannot speak on just how large of an account you're talking about. All I can do is give you a quick couple of tips on how to execute just option trades in general. Is what I typically do is, because Thinkorswim and Interactive Brokers are very good, and I've never really had any problems with either, when they show you the mid price, it's typically fairly close to what the actual mid price is. So let's say it's 20 cents, negative 20, a credit of 20 for a Broken Wing Butterfly. I'll see that mid, and I'll try to do a little bit better. So maybe I'll do 22 of a credit, and I'll just sit there for 20 seconds. And then knowing that I'm probably not going to get it, drop it down a penny or two, I'll do the 20 cents credit and wait 15 seconds. You don't have to wait all day long. You don't have to nickel and dime everything, because remember, the market could go up or down in the next 5 minutes. I have no idea. 50-50 coin flip. So I'm not going to try to get the best possible price in the moment, because it could just go the other way, and now I'm chasing it the other way. So wait 20 seconds, drop it to 18 cents or 19 cents. And in my experience, I don't think I've ever taken longer than 2 or 3 minutes to get one of these done. So I'm not claiming that I have the largest account in the world, but it's not small, and I'm doing a lot of contracts, and VXX is liquid enough to do everything that I need. Certainly, that is one key to option trading, is you always want to trade liquid underlines. And just another side note tangent here, but remember to calculate that on the exit as well. What a lot of people do is they look at the liquidity on the entry and they think, well, it's probably good enough. What you want to imagine is, what's that going to be like? Use your experience. What's that going to be like in a crunch, right? When everybody's looking for the exit, is the liquidity good then? You want to know that liquidity is good on the entry in a calm market and on the exit in a chaotic market. And I definitely think that VXX qualifies there. So apologies if you're trading a $10 million account and you're trying to push a $100,000 Broken Wing Butterfly through. You might have to take an extra minute or two. You might get a penny less. I don't know. I don't think so. VXX has an enormous amount of contracts and volume, but who knows? But that's how I do it. Option trading is a matter of being a little more patient than equity trading. When I'm trading the SPY, it's penny wide. I oftentimes just use market on close, but don't ever use market orders on options, and you will have to do the 1 penny, wait 15 seconds, 1 penny, wait 15 seconds. You might have to do that. This is interesting. What's the statistics UVXY goes green in consecutive days? How to find such data? Well, to find the data would be very easy to do in Excel. You could just get the UVXY data. I don't have that. I don't see how that would be useful for me, so I've never actually run these numbers. But here's the VXX for, you can see long-term, it decays 2.1% a week. I've got all the VXX data, UVXY, scaled back to 1.5, what it currently is, and simulated all the way to 2004. So all I would have to do is add an extra column and see it would basically look like this. If, where's a percentage? Here's a percentage. It would look like if this is greater than 0%, then 1, otherwise 0. I would just do something like that. And then basically on a 1-day time frame, you could do another function that basically adds it up for you. Or you could say, well, 3 days in a row or 4 days in a row. You could totally do this. One thing that I'm kind of trying to think about is why? Because Maybe you know something I don't, but why would that be useful? I tend to think of markets as a random walk day to day, and what I am far more concerned about is the underlying volatility metrics in the VIX futures market, the VIX, the Volley, the VIX 3M, 6M, all of those things. I'm concerned about the daily changes in those. I'm not at all ever looking at the daily dollar change of UVXY or the percent change day to day. I don't think that that's relevant to anything that I do. So maybe I'm missing something, but how would you do it? First of all, you'd want to get your data. Secondly, you'd want to do basic functions. See when it's up and when it's down day to day. And then do a third function on top of that. How many days in a row? If this is positive for 3 days in a row, check. If not, make a green column, highlight it, make it blink, whatever you do. It's not that difficult to do. The harder thing is understanding the why, the macro, 30,000 feet in the air. Why are you doing this? And how's it going to be useful for you? If you've determined that it is useful for you, then do it. Absolutely do it. Don't ever trust somebody else to do it. Even me, I'm a very detail-oriented person. I will not give you the wrong answer. I will go through it, make sure that it's correct. But even then, just do it yourself. What you'll find oftentimes when you're doing these basic things is that your brain will ask 2 or 3 follow-up questions in the process of finding this one answer. You'll ask 2 or 3 more questions and you'll keep going. And then you'll go and answer those. And then your brain will say, well, okay, well, what about this? And all of a sudden, a year later, you've got a spreadsheet that's huge and you've got a knowledge base that is generated based on real world experience, rather than just having me calculate it and say 36% of the time. Okay, you didn't learn anything other than the answer, but there's no follow-up, there's no experience. So I always encourage people, when it's something this easy, do it yourself. Get your data, first of all. Do you have the UVXY data? That would be a good place to start. Once you get that, I am not an Excel expert by any means, but I can just kind of make it work the way I need to. Can you explain why trading VIX 8 futures requires more margin than VIX 4? No, I don't trade the VIX futures. Ever. We don't do any futures trading within my community. Logistically, it's a nightmare to add on additional education and additional permissions with brokers. And some people can't do it. They're in margin accounts, and they're in cash accounts or IRA accounts. So we don't do anything with futures at all. And so I've never actually traded the VIX futures past the front 2 months. I was not aware that there was a different margin for the VIX 8. I'll look into it. It's interesting. I would imagine it has something to do with the liquidity, the additional uncertainty. It doesn't make sense to me. I don't know why there would be a difference. Okay, what time is it? Maybe should make this the last one. I'll just go over them briefly right before I turn it off, but yeah. All right, I'm new to VTS. When should I purchase the first VXX put option for tactical VTS? Anytime, as long as your barometer is showing a positive signal or after a spike. I want to avoid a quick drop after starting. Don't we all, but it's an impossibility. Since VIX is currently low and VXX is closely tied to VIX, mean reverting VIX could put me in a negative territory soon after starting. So you layered about 4 things in that second part. Let's start over. When do you allocate? Well, there's 2 ways to do this. Let's say you join today and you look at my daily trade signals. This is the email from today, right? So there's, the standard stuff. You've got the barometer. You've got a couple of blog posts. And then you've got the signals. So it says, no new trade, long MVV. I have been in the MVV since September 29th without changing position. We're just riding this trend. Stocks have been going up for a month and a half. We have just been riding this trend upwards. So I obviously have a very advantageous cost basis, right? I'm up, let's say, $10,000 on this trade for the portfolio. Well, you're not. You're just jumping in. So there's 2 ways you can do this. You can either, because I do everything on a day-to-day basis, this trade is only based on today's metrics. And tomorrow morning, I'm going to wake up, I'm going to check all the metrics, and I'm going to give the new, fresh trade signal. Whatever the email says is active for that one day only. It's not active for a month. It's only active for the next one day. And then the next day, I'm going to do the same thing over again. So everything you see in the email, you can take as well. Even if you join today, cost basis doesn't matter. Whatever happens tomorrow or Monday with the MVV, it's going to happen to both of us equally. So the question that you're asking is essentially, should I jump into this strategy? You're worried that you jump in and then over the weekend something goes wrong and then it spikes up. Well, one thing you could do, the second thing you could do is wait for a fresh signal, right? Just sit and wait. It doesn't really matter. I mean, on a long-term 30-year time horizon, what you do tomorrow is not going to matter really at all, unless it's something that's catastrophic, which my portfolio is designed for safety, so it wouldn't be. But yeah, you could do a fresh new signal. That's the two ways you can do it. But the one underlying thing that you want to avoid is thinking that what you do today matters. It really doesn't. What the most important thing to do is do the right thing always for 30 years. Do more of what works, less of what doesn't, and in the long run, you will end up where you want to go. Now, can I sit here and say that if you take, I've been in that position for a while as well. We've rebalanced this one already. So this is actually a new long-term put option. We've been in this for a month and 10 or 12 days. If you jumped into this position, is it possible that, we've been riding something pretty good? Is it possible that it spikes up and hurts you? And you're in a situation where you joined a service and the very second day that you joined, you lose money. Yeah, absolutely. That could happen. I have no idea where the market's going to be Monday. I just know that today my money is allocated to short vol net long equities. That's all I know. I'll tell you Monday what the trade is Monday because I'm not living in Monday. I'm living today. So Monday morning, I'm going to give the email and the signals to everybody, and it's going to say either maintain the VXX put or it's going to say move to cash. Those are the two choices. Don't know which one it's going to be. It's highly likely that it will not be moved to cash because we're in a pretty strong trend, but who knows? Maybe we will. As far as thinking that you're going to be able to navigate this world without taking trading losses, you can't do it. Just accept the fact that we don't know what's going to happen in the future. So do the right thing. The right thing for me and my money, can't tell you what to do, but the right thing for my money is short vol on Friday, November 12th. I think it's the 12th. Yes. Short vol on November 12th is the correct position to be in. That's all I know. Don't know what the correct position on November 15th is. Have to wait for Monday to see that. But yeah, you can either take it knowing that cost basis is basically irrelevant and whatever happens Monday affects us in the same percentage, or you can just sit on the sidelines for a little while, wait for the next fresh change of position, and then jump in then. If you're more comfortable doing that, by all means do that. Again, what you do in the next week or two is really not even going to be a blip on your long-term portfolio chart. So don't stress over this decision too much. You're either going to get into the same portfolio I'm in, or you're just going to sit and wait until something in the market happens, moves us to safety, and then jumps us back into equities in a future trend. Go ahead and ride that one. I don't mean to be trivial, but it's really, either way, it's not going to matter that much. Might matter emotionally. You might think, oh, I joined this service and I'm immediately down 5%. Yeah, that's not going to be much fun, but that doesn't often happen, but charts look like this. I don't know when people are joining and leaving. So yeah, it happens to some people. Some people take losses the very first day. Some people have their best week ever in their first week. It just, whatever. I don't tend to look at the short-term noise that much. But yeah, if you're comfortable, go for it. If you're not, wait for the next trade. And that's it. So, okay. We did 2 segments. They ran too long, so next stream, probably next week. I might be going to Las Vegas either tomorrow or Saturday or Sunday. Just for a little while, just for a few days. So maybe I'll do a stream in Vegas next week, but I'll try to get the Q&A to a half an hour next week. That's my goal. So thanks everybody for watching. Have a great